Our next guest says growth is a defensive strategy. He likes sectors offering reliably strong sales growth, including AI and fintech. Let's go to Drew Pettit, U.S. equity strategist at Citi Research. Drew, thanks for joining us today. Appreciate your time.
Hey, happy Monday. Thanks for having me.
How is growth defensive?
Look, it's funny. I was just listening to your previous guest before the break, and talk about defensible top lines. It's in secular trends. If we get a slowdown in the economy, or if we have more tariff pressure, or interest rates go up because of deficit concerns in the United States, companies still need to invest to be more productive, to be more efficient, to basically weather that storm. So we think what is defensible in this environment really isn't low margin staples. It's not, seemingly cheap cyclicals. It's basically names that can keep growing in any environment, and those that can take that top line growth and turn it into even stronger earnings growth on the bottom line.
Okay, so how much do you expect AI to drive growth from this point? We know that there's already been the big AI boom. Do you expect it to continue, or do you think much of that has already filtered through?
So it's funny, a lot of that at the beginning of the year was really priced in and filtered through. We had the DeepSeek scare when it came to chips. The growth side of the market sold off really aggressively. When interest rates started to move higher, again, growth took another leg down. And now when you look at the CapEx numbers coming out of the reporting period in the United States, these companies are still investing for AI. So that trade has snapped back really aggressively. So how much growth is really coming from AI or some of these other growth themes, kind of hard to tell. But where we have the most conviction is in something like AI, is in something like fintech, and something like digital leisure, or even automation types of names as well, get really interesting here.
Okay, so talk to me about digital leisure. What does that look like?
Yeah, this is really interesting. So think about how we consume entertainment now. It used to be going out and doing things, restaurants, vacations, and so on. If that spending pulls back, I tell you, you're probably not cutting all of your subscription services, the mobile games on your phone, and whatever your kids are into at home, that's probably a tough cut. So those types of entertainment, accessible 24/7 types of companies and trends, those are really sticky. Those consumer dollars kind of stay there. And those, honestly, because they're sticky, because they're delivered digitally, again, for every incremental dollar to the top line, you're getting more to the bottom line.
You also like, and you mentioned this contactless economy, things that work in that sphere. What are you looking at there? What does that look like to you?
Yeah, it's funny, it's two-pronged. So if we're talking about manufacturing renaissance, whether it's because of tariffs or just honestly, this has been a trend that's been in place for a while here, manufacturing isn't going to be as labor intensive in the developed world. We've seen that change. So tooling and automation becomes extremely important, whether you're creating a complex industrial good or something as simple as maybe fencing, for example, like on the consumer side. So automation and design, it could be a company like Autodesk that helps companies design and blueprint machinery and so on. And honestly, from the consumer side, ease of spending, it could be like a digital interface like Instacart, MapleBear.
Okay, and then do you differentiate with fintech then? What is a fintech stock for you?
This is where you get into the MasterCards of the world on the payment side, or the Fiservs that are basically the plumbing in the background. Honestly, we still have complex banking systems, complex monetary systems. I think there's a lot of wood to chop here to clean up. And this is a type of structural trend that could make our lives a lot easier, could make a bank like where I work, a lot of the back end a lot easier and cleaner as well. So again, a lot of investment in those types of areas. And look, it's not just the startups, some of the big companies like the card companies I mentioned that really make ease of commerce, a secular trend, sticky.
Okay, so you prefer, like many people, buying out a pullback. But at this stage, when so many have already started to come back and come back strongly, what kind of assets would you buy?
Look, if I was looking at my portfolio today, I would stay invested in the large cap growth names. Again, more up cap, higher quality, can manage different interest rate environments, can manage different economic environments, and all the news flow swings that we've been seeing left and right. So we would stay up cap in growth. And honestly, if I had a chance, I'd probably be paring back my small cap exposure.
Yeah, we see a lot of people doing exactly that. What's your target for the S&P 500?
We're at 6,300 for year end. And honestly, it's been a tough year to put targets out there. We started the year at 6,500. On Liberation Day and what we thought was going to be a more aggressive tariff backdrop, we cut our target to 5,800. And just this week, as we feel better about fundamentals going forward, we raised it back up. So we've almost come full circle here. Honestly, we're probably going to get more policy noise and volatility than we'll actually get earnings volatility for the rest of the year. So we're getting more comfortable with U.S. stocks here.
Got it. Drew Pettit is a U.S. equity strategist at Citi Research. Drew, thanks for joining us today.